Hello and welcome to our first pre-budget town hall, which looks at the macro numbers and the macro thrust which the February 2025 budget will hopefully bring forth. First, the assumptions of GDP growth, tax growth, fiscal deficit, all these are going to be made at a time when the macros of the world and the country are in a state of flux. So that's the caveat. Now, the macro questions that we need to ask ahead of the budget are what we are going to do today. First, should the government stick to its program of cutting the fiscal deficit to 4.5%, especially when the economy is slowing and may in fact be in need of some stimulus? That's the first macro question. A second issue that the government has to face is that it has not quite been able to spend the capex money that it laid out in the budget estimates of July 2024. It was estimated that the capex will grow by 17% to 11.1 trillion rupees, 11 lakh crore. But the capex up to November has actually undershot, has fallen by 12.5% versus April to November last year, which means it's just about 5 lakh crore that has been spent. So should it blindly increase the capex budget at all when there seems to be a bandwidth problem? Third question, should it lower its tax estimates, its GST collections? Because the GST collections so far have grown at only 9%, whereas the budget estimate was 11%. So clearly, there is a consumption slowdown. However, on the other hand, income tax has grown by 23.6%, whereas, April-November, whereas the budgeted number for the full year is only 13.6%. So, should the government consider cutting personal income tax so that consumption can be boosted? That's one big question in front of the market. And finally, what should be the overall thrust of the budget? Should it continue with last year's theme of a thrust on employment? Or should it promote exports and aggressively get into the global supply chains, given the likely Trump tariffs ecosystem? That's a point that we will discuss. Of course, we will also discuss the most important question facing the economy now. How will the pressure of the rupee impact the budget? What parameters may be pressured? Those are the questions. Well, there will be, of course, many more questions, but for that, let me welcome my co-anchor, Prashant Nair, onto the dais. Let me also welcome our guests. We have three top-ranking economists, Samiran Chakraborty of Citi India, Neelkanth Mishra of Axis Bank, and Sajjid Chinoy of JPMorgan. Two of them, of course, Neelkanth and Sajjid, are also members of the PMEAC, and therefore we are going to expect them to give us some idea of what kind of a thrust the budget may take. Gentlemen, take your seats, please. Prashant, you included. Well, let me start with a half volley. Okay, growth assumptions. We already have the MOSPI number, that is the Ministry of Statistics and Program Implementation. They gave us an estimate for the current year, which was, lower, 324 trillion, whereas the budget had estimated 326.3 trillion. We didn't make it to a 10% nominal GDP growth in the current year. So, okay, let me start with you, Sajjid. Do you think this year we should have a lower growth estimate? Everything, lower tax estimate, simply because we are living in, look at what the stock market is telling us. Probably earnings are going to be lower, probably global headwinds are going to be terrible. So is it safe to assume a single-digit growth assumption?
The fiscal assumptions, for the most part, have been very conservative in the last 2-3 years. I mean, in years where people had higher nominal GDP assumptions, the budget was taking 10.5%. Last year, the gross tax collection number was 10.8% on that number. So it was quite conservative. Really, it'll come down to how policymakers, what they make of the global environment. As you mentioned, the last 2 years, nominal GDP has averaged less than 10%. So if one wants to really be conservative, I think a 10% number would be conservative. And on that, if you really, want to be conservative again on taxes, typically you tend to get higher tax buoyancy when there's an upswing, and when growth is in a kind of a cyclical slowing, tax buoyancy tends to soften. So I think a nominal GDP of 10% with a tax buoyancy of 1 would be quite a conservative assumption. But again, if the government were to assume 10.5, these are not very big changes. There are things that can be offset as the year goes on.
On buoyancy, it's different because we have assumed a higher buoyancy just for the benefit of the audience. If there is a 1 rupee rise in GDP or 1% rise in GDP, a similar percentage is assumed in tax increase. That would be called a buoyancy of 1. But Neelkanth, to you, same thing. Should we assume conservative than usual estimates and also be conservative in tax estimates? Simply because the wealth effect is eroding so fast that the stock market is taking it away.
Okay, so once you do the numbers, I think you have to get down to the weeds and look at different taxes differently. So personal income taxes, I think there has been a significant boost from capital gains. So the share of capital gains taxes in personal income taxes has risen very dramatically. From 2001 to 19, the personal income tax to GDP was rising at 5 basis points. Since 2019, it has been rising at 20 basis points. This year's number is 30 basis points. Now, I think that we have to be reasonable that with this kind of market, I think capital gains will be lower.
Gains also, the tax also was increased.
Yes, yes. So I think if you take a reasonable number, maybe an 8 to 10 basis point increase there, because see, there is an upward sloping curve there as India becomes more prosperous, more formal, that will improve. Corporate taxes so far is minus 0.5%. Now, given that even on reduced numbers, I know FY25 earnings for the listed space have been cut very sharply, but even on reduced numbers, we are still talking about 9 to 10% growth. Even if you assume that there is a significant negative impact from the unlisted space and the smaller firms, still I think this seems like a very, very low number. Very likely there has been a spate of refunds. That's something that has hurt, I think, December GST as well. The headline number looked scary, but the gross number was actually, the net number looked scary. The gross number was up 7.5%, 8%. So I would say that next year, if you assume a 3.02%, which is back to FY19 or 18 levels, that's a reasonable number, which will mean that corporate taxes could grow faster than nominal GDP. So once you look at all of this, there is no reason to be unduly pessimistic on the tax buoyancy question.
Right. I want to ask all of you a simple question. Is this a budget where, which needs to help the economy in some way by providing a little bit of fiscal stimulus, right? From a stock market point of view, that is a number one question. I think it's a number one question every budget. I think Sajjid is smiling. I think going back how many years? Maybe 10, 15 years, but maybe this time especially because of what markets are doing. Samiran, why don't we start there? Set the context for us. And then we'll get to if it is possible, because the global environment seems to be a little adversarial. Go on.
So first, from a budget-making perspective, the assumption that needs to be made is that how much of a recovery in the economy the budget will assume, or in other words, what is the assessment of the growth risks right now? And then the question will be that to what extent the fiscal policy is in a position to address that risk versus, let's say, monetary policy. And typically in the last few years, what we have seen is that fiscal policy has been very conservative. And one argument is that when anyway there is so much of global headwinds, including the pressure on the currency now, it makes sense for the fiscal policy to stay conservative. Add to it the fact that after 19 years, S&P has put us on a positive outlook with a chance of a rating upgrade a couple of years down the line. At the last mile of that, we don't want to deviate too much from that. So these are all arguments in favor of keeping the fiscal somewhat tight. The question is that why it becomes a closer call is if you assume that the growth slowdown is significant, that then a counter-cyclical fiscal policy might be required as well. To me, the big sort of uncertainty is that, let's say hypothetically you move from 4.9 this year to 4.7 next year. Is this going to at all stimulate the economy? But it's probably more difficult to have a fiscal deficit number higher than this year because of obvious reasons. So at the end, on balance, it might make sense to stay at that 4.5 kind of a number because you get all the benefits of macro stability associated with it and hope that the monetary policy takes more stimulus efforts than the fiscal does.
Let me put it another way. Had it not been for this global environment, which is slightly adversarial, would you have said maybe makes sense to expand the fiscal a little bit, not go to 4.5%?
See, that's the whole thing, that there is a credibility which is very difficult to quantify. This promise for last few years, every year, the fiscal authorities have met that promise. And that has created a certain amount of credibility. Sometimes when the credibility is there, we don't appreciate the value of the credibility. But at this juncture, whether it's worth losing that credibility just for 20 basis points of fiscal, I doubt that the government will go that path.
Well, you doubt the government will go that path, but we can argue whether that is needed now. It's not just meeting that 4.5. It also means crunching. You know, it is taking back a fiscal stimulus. It is reducing the support at a time when the consumption is clearly ailing. I mean, we can see that in the GST numbers. They are not coming up to even the nominal GDP growth numbers. So, Sajjid, and you know, what are we faced with? A Trump who says that at 8% fiscal deficit, I'm going to cut taxes. I mean, what is so sacred, yaar? Nobody else is respecting it. Why should we?
So there are two ways to think about this, and it's an intertemporal trade-off, right? Short term versus medium term. The domestic versus global problem state in my mind is, how do you respond to a cyclical slowdown without letting your guard down on a very hostile global environment? And you have to get the balance right between fiscal, monetary, and exchange rate. In the case of the fiscal, again, there are two objectives. I think the government has been very prudent in a correct manner for the last 3 years. And their objective in the medium term is very clear and the right one. We want to bring debt to GDP down over time. And you know why that is important? Because with nominal GDP below 10% for the last 2 years, despite deficits going down, combined public debt has inched up. Because at these levels of nominal GDP, debt is going up. Now, in this kind of world, you don't want to be in a situation where India is regarded so highly for macro fundamentals for public debt to again start creeping up. So the right objective is to stabilize public debt and then bring it down. Now, the end state fiscal deficit for that, I would argue, is much lower than 4.5%. So eventually we have to go to a number much lower than 4.5 if you assume nominal GDP settles around 10 to bring debt to GDP down, which is the fiscal framework that the budget spoke about last year. The question really is the pace at which you get there. And that's the only question really, that if we're starting at 4.9 and we eventually want to go to 4%, how should we stagger that? Now, there's a good case to say that maybe slow the pace, reduce the deficit, but slow the pace of consolidation so that fiscal tightening does not offset monetary easing. But as Samiran said, it's a judgment call, because 20 basis points of fisc, how do you trade that off with the credibility and the risk premium that go down because of good fiscal marksmanship? And that's a judgment call that policymakers have to make.
You are in the camp of a 4.7?
Again, it's a judgment that has to be made about where will the global environment be next year. Remember, we also have, I know we're cutting it close, but Donald Trump takes office January 20th. Expect a raft of announcements right after that. The budget's February 1st. One can make judgments about how difficult the global environment gets. What does that mean for India? We hope to see some monetary easing. Will the economy recover over time? If there's a recovery, we'll get some tax buoyancy. What I will say is, if we are going to reduce the deficit, it should be a revenue-based consolidation, not an expenditure-based consolidation. That we should reduce the deficit based on revenues, not by cutting expenditure any further.
And let me get in 2 points here. The first is that look at what is happening to UK gilt yields. Look at what is happening to government bond yields across the world, and look at what has happened to our yields. They barely budged. So other than China and us, I mean, and Japan as well, most other yields have actually gone up.
But UK specifically, I mean, growth is zero.
Yeah.
So, I mean, is it a slightly different situation as compared to...
But see, what I'm trying to point at is that the fact that our yields have not moved is something which is very positive. It's a big positive, and we have to appreciate that and not let go of that positive as we try to fight some other battles. The second thing we have to keep in mind is that as you rightly said, the fiscal deficit in the first 8 months being well below what is average for this period has been a headwind. But as the government tries to catch up on its spending, as we enter the new year, there will be a fiscal boost. meaning that all of this money, if it is spent, see, if the government is unable to spend what it has budgeted for, we will end up this year much below 4.9. If they are able to reach 4.9, will mean that there will be on this 4-month basis, there will actually be a significant fiscal stimulus. So to expect that you should let go of the 4.5% target for next year, when you're already going to have this stimulus next year, if you're not able to spend, then anyway, there's no consolidation next year.
Right.
And at some point, we'll get to the RBI and the credit growth as well. But let's not blame everything on the government fisc. How much space do you really have?
So if they say keep the fisc at 4.5%, with 4.5%, can they do within that 4.5% to stimulate the economy in some way? Or, you're actually, that's not going to happen. You're coming off, it's contractionary.
Macro theory says that an increase in fiscal deficit is a stimulus, a decline in fiscal deficit is a drag. So if you're bringing it down, you're theoretically,
Taking away steroids.
Yeah, and the quality of spending is meaningful over a 2, 3, 4 year period. The multipliers come in. Because the first year, it's just the spending. And therefore, I don't think you can anyway do some magic and bring down the fiscal deficit ratio and still have a stimulus.
You can't rejig spending one way or the other in terms of priority, Sajjid? Any?
We'll have to do that. 1 minute. We have to take a break. But that really is the big question. How do you rejig expenditure within it?
Spending
Will you do more
priorities.
revenue and less capex? That question is there. And there is the overall, to what extent is the ambience of pressure on the rupee and global headwinds going to impact budget making itself? All those key questions in a minute after this break. Welcome back to our first pre-budget town hall. We have with us Axis Bank's Neelkanth Mishra, Samiran Chakraborty of Citi, and Sajjid Chinoy of JPMorgan, and we are discussing what should be the macro thrust of the budget. Okay, we will discuss the slowdown a little later because it's so all over the place that let's push the pessimism behind and see what can be done proactively. Okay, Neelkanth, one of the problems appears to be the government has not succeeded in doing its capex budget. Sometime back, I remember you saying that it is not very easy to do expenditure.
Yep.
Maybe there is a bandwidth problem over there. They are just pushing the loans to the states and with conditions, and the states are not able to meet the conditions, so they are not spending. Should this whole, capex bogey be stopped for now, and you look at revenue expenditure in some ways?
No, so let's define the problem correctly. As per the Constitution of India, the central government can spend on national highways, railways, telecom, airports, national ports, or the major ports. Major ports, airports don't need much capex. Telecom, once the BSNL 4G capex is done, is ruled out. So you are left with national highways and railways. How much capex can you do on that? In national highways, if you have 160,000 kilometers of national highways, if you are building 14 to 16,000 kilometers a year, once in 10 years, you'll need to relay the road, so you can't do more. Railways can absorb more, should be doing more, and it is starting to grow, but you can't go from 1.5 lakh crores to 6 lakh crores in 3 years. So they've gone from 1.8 lakh crores to 2.5 lakh crores this year. Maybe they'll do 3 lakh crores and then 3.5 lakh crores next year. Where else will you spend the money? And which is why 2.1 lakh crores of this year's spending, so 1.5 lakh crores was the interest-free loans for capex to states, and about 64,000 crores is lying in the DEA budget, the Department of Economic Affairs budget. Some of it is that pre-commercial R&D. Some of it is side pocket stuff, which is in case someone asks, we will give it to them. But this year, as people are struggling to spend what was given to them, that money may not be spent. So it tells you that there is a serious issue with how much the central government can spend by itself, and therefore, should it then plan different programs? And so policy making is about identifying problems and solving them. So is it that if urban infrastructure where there is unlimited demand for infrastructure, should the government create programs and say that, okay, in the next 1 year, I'm going to allocate 2 lakh crores to, say, the top 50 cities, and these are the programs? And if that was to happen, I think the absorption will be much better. So it is about creating and designing those programs rather than just the scope to spend.
No, we can get onto a different conversation on this. I think fundamentally the central government made a mistake by taking away the shareable resources in the form of cess. If more was shared with the states, probably they would not have been in that position. But that's a separate debate to have. Samiran, even this year, if you looked at the expenses of the roads ministry, roads ministry could not spend its entire amount. What are your key takeaways from the current year's April-November budget numbers? This inability to spend, and therefore, what would you recommend?
I think I will agree with Neelkanth that diversification of capex is the main theme that we have to work with. We can all discuss and debate what are the areas in which the diversification needs to happen. Let's say, for example, we are already seeing it in railways. If you look at the subcomponents of railways, the component which in FY25 itself saw the maximum jump is actually modernization of railways, which saw a 66% increase, not any more laying tracks or electrification, which used to be dominating railway capex in the past. Similarly, Neelkanth suggested one idea about urban development. For me, another idea could be to do a very large-scale social housing project in India, which has big forward and backward multipliers. So we can debate and discuss. There could be areas around water where public capex needs to come. But it's quite clear to us that roads and railways, and obviously defense also we count as part of capex, these three with more than 60% share cannot be driving this double-digit capex growth for very long.
But any thoughts on why? Roads was a ministry which spent very well up until last year. What could have gone wrong this time that it is less than last year, April, November?
Sometimes it could be a bit of lead-lag things also, because I don't think at least the highway data is showing any decline in actual real highway activity.
Maybe elections, maybe?
Yeah, but election, you could justify it for the first couple of quarters. But this continuing even in the October-December quarter is a bit of a mystery. But it could be a lead lag between the work happening, but the payment getting a bit delayed. We know that the payments can happen in a bunch also at one point of time. So we are still expecting that in the last 4 months there will be a significant increase in public capex. Despite the full year number being maybe 1 trillion lower than what the budgeted is, we could still get a good 30% plus growth in the last quarter if those bunched up payments get cleared in that quarter.
Sajjid, just your thoughts on...
No, I think let's step back and look at the bigger picture, because before the pandemic, central capex to GDP was 1.7% of GDP. Nice. In 4 years, it's doubled to 3.2% of GDP. This year, we're targeting 3.4%. At some point, you can double fiscal resources, but doubling state capacity and absorptive capacity is a multi-year project. So you're going to have to face this point that at some point you're going to hit this constraint. Now, this year, I think there is an identification problem. How much of this is because of election? We saw in November, for example, capex has grown 20% year on year. So will the next few months make up for that? Or are we now hitting some absorptive capacity? Because it's not just at the center. There's so much focus on the center. Look at the states. And the states, I would argue, the problem's a little bit more pernicious, because if you look at the first 6-7 months of this year, the quality of spending has worsened because you've seen revenue expenditures and subsidies go up, but capex has come down. So I think it's important first for us to stabilize and consolidate where we are. We went as a country from 1.7 to 3.2. States last year went from 2.4 to 2.9. We don't want to erode this gain. So even in next year's budget, if we can just consolidate capex at a 3.2, 3.3% number for the next 3 years at that higher level, and while we're doing that, build state capacity, as Neelkanth and Samiran are saying, where are the areas we can spend? What is it? What is the public-private partnership that's involved? What is the state capacity requirements? That's the nuts and bolts of what needs to be done. But we have to be realistic here, that you can't be doubling capacity every 4 to 5 years from a state perspective.
So do you think, Neelkanth, therefore, the big, one big thing that the government can announce is a state-center cooperation plan, or a state-center municipality cooperation plan, something which we have not really gone ahead?
I think that's something that I would definitely prescribe. and I am prescribing that. Whether I'll predict that or not, I mean, of course, we'll have to wait for the budget to see.
Okay. So, I mean, how do we see the budget? How do we see the economy getting any help at all? Should we not expect it from the government? Should it be monetary policy that you say will be the first line of...
The fact that the government is ceding space for the private sector is an important thing. See, we tend to just look at the government to keep doing spending, but remember that what economic theory says is that private sector can spend the same amount of money much better than the public sector. Now, let's not forget that the last 4 months, as Samiran was also saying, that there will be significant growth year on year in capital expenditure. The cuts that we have seen on the CRR side, I mean, of course, a lot of that has been offset by the rupee interventions, but there will be a multiplier on the 1.16 lakh crores. And so as the money starts to come into the system, and hopefully the RBI will also ease macroprudentially and start to, not be as restrictive on credit as it has been, one would assume that the growth numbers will start to come back. So to expect that the government should, use the very little resources that it has to take on the burden of stimulating the economy forever is, I think, inappropriate.
I think we have to be very clear here. The first point, right, that the aggregate fiscal impulse is contractionary when deficits come down, and we have to accept that reality. Deficits went up in the pandemic like they did all over the world. Public debt has gapped up. Now nominal GDP is in the high single digits, below double digits. Deficits have to slowly come down, and that means the first order impulse is contractionary. Holding that constant, there can be second order impulses. What is the quality of spending? Can we get spending which have got higher multipliers that over 2-3 years you offset the impulse? But we have to live with that basic recognition here that there is no space for an expansion, right? That there has to be a consolidation. We're only debating the pace of the consolidation at this point.
There is no reorienting the spending within that 4.5.
Well,
not possible.
Again, so if you look at where we're going to most likely end up this year, capex should be close to at least last year's number of 3.2% of GDP. The question is, if you've got to get a 40 or 50 basis point consolidation next year, where is that going to come from? Now, some of it may come naturally because some elements of expenditure, interest, for example, don't grow in line with nominal GDP or in defense. But if I look at revenue expenditure, ex-interest and ex-subsidies, we're already back to the levels we were in 2018, 2019. We're back to about 6.5% of GDP. Personally, I would not want that to go lower. And I don't want capex of 3.2% of GDP to go lower. So the real budgetary calculation is going to be, how do I get 40 to 50 basis points or 30 to 50 basis points of consolidation without really cutting revenue expenditures and capital expenditures? How much do I get from lower interest, lower defense, maybe lower subsidies, and slightly higher tax revenue? I think it's important how the consolidation is achieved. So two things matter. What is the quantum of consolidation, and is it a revenue-based consolidation, or is it an expenditure-based consolidation? I think that will make a difference going forward. Last point I'll say is there's so much focus on fiscal math where you've got limited degrees of freedom. I'll be looking for what are the non-budgetary announcements, non-fiscal announcements in the budget. This is the first year of the third term, and I think there should be as much focus on those qualitative announcements as there should be on the nuts and bolts of the fiscal math.
You have defined for us the theme that we had in our mind for the next segment as to, what are the policy thrusts that the government can do. But just a word on the suggestion that Samiran made. Housing has an inherently multiplier impact.
Yes.
You think that could be a thrust the government? I mean, we do have an Awas Yojana which gets a lot of mention in the budget. Can that be stepped up? I'm just looking for the big theme in the budget.
See, we can keep discussing whatever we can be, but people making the budget may have different thoughts. But if we are prescribing, is real estate and housing a very important part of demand in any economy? Absolutely. When people think about capital stock, everyone obsesses with factories and capital investment in factories. Remember that capital stock in most economies is almost one-third in terms of housing, urban infrastructure or infrastructure and factories. So building this up, and especially given that real estate cycle after 10 years of downturn is starting to turn up, and stimulating that or supporting that with some affordable housing is a very good idea. How to execute that? Because, even countries with high state capacity like China have struggled with affordable housing. These are not easy problems to solve at scale. But I'll just add to what Sajjid is saying, that if you look at the fiscal math, it's actually reasonably simple. If your GDP is growing at 10%, if the fiscal deficit quantum remains the same, the deficit will come down from 4.9 to 4.5. So your fiscal deficit remains the same.
Remains the same. I think it's 16 trillion.
Yeah.
The math.
And if your tax to GDP remains the same or goes up or down a bit, it will grow at about 10 to 11%. That gives you at a gross level about 4.2, 4.3 lakh crores. Net sharing of taxes gives you 3 lakh crores. Subtract from that 1.2 lakh crores of interest cost, you have 1.8 to 2 lakh crores to play with. Some amount will be DA, pension, this, that, some defense expenditure increase. You are left with some 80,000, 1 lakh crores that you have to decide what to do with. You put it in capex. That is the budget math. I don't know why it is so complicated. So
But then this year you will have a problem, because I don't think RBI is going to give that much dividend, no, Samiran? The way in which the reserves have come down.
No, but the interest rates have gone up. So they're earning, the US is paying
Is the
us.
average interest rate up? It would be down, isn't it, on treasury bills?
Income of RBI would probably be very similar to last year. The only
Can give that 1 lakh crore.
The only unknown is how much provisioning they will have to do. Last year, the provisioning was about 80,000 crore. This year, our view is that the provisioning could be much larger, provisioning requirement. Typically, in a year where the currency is more volatile, the proportion of economic capital that RBI needs to keep, that proportion typically has to go up, and that might imply more provisioning. So we are budgeting more like a 1.5 type of a number on RBI plus PSU dividend, which could be
even if it's the same
0.2%.
as this year, remember, as a percent of GDP, it goes down next year, because they know it's going up at 10%.
But remember that if the rupee is weakening, they will also book gains.
Yeah.
So anyway, I don't think it's reason. We can say with surety that the dividend is coming down.
So I think Sajjid has given us our next topic to discuss, raising resources, right? You said non-tax resources, and I think that's the big one. So let's take another quick commercial break here at this point, and we continue the conversation with the three gentlemen here. And as I said, we'll ask each of them what the government can do to increase its kitty, because at the end of the day, that is essentially what will matter, what will decide how much can be spent where. Stay with us. Welcome back to our first pre-budget town hall. We are, of course, discussing macros with Axis Bank's Neelkanth Mishra, JPMorgan Sajjid Chinoy, and Citi's Samiran Chakraborty. We've been, of course, going through the paces with what is possible in the budget, what is required, and I think what is constraining what is required is what is available, right? And as Neelkanth said, there is only so much to play with. Sajjid, we hear this thing about divestments every year, and that number is very, very closely watched. Maybe this year, not that much, because prices have come off quite a bit. Last 2-3 years, we've had this fantastic bull market, but we didn't really see anything happening. You think we should expect anything?
I think we should just step back and kind of recognize that over the next 2-3 years, deficits have to go down at least 0.5% of GDP, maybe 1% of GDP from your macro framework of bringing debt down. Now, given where revenue expenditures, as we discussed, there's not much left to cut there. We don't want to go backwards on capex. So the only way to square the circle is to focus on the revenue side. Now, the revenue side, to be fair, in the July budget, the Finance Minister did say about a review on direct taxes, and so hopefully at some point we'll see that as well, that the whole direct tax code gets redone. You can benefit from the Laffer curve over time, reduce rates, broaden the base, get some revenues. But there is another untapped channel here, and I've been going on like a broken record for many years, so you've heard this story before, that asset monetization, not just disinvestment, that India has a large pool of assets, some of which you can sell in the market. And again, markets go up and down. This may not be the most appropriate time to discuss this, but who knows where markets will be 6 months from now or 9 months from now. So we have to be nimble that in those, and the benefit there is not just a resource, it's that you're creating value by selling it to someone else that can manage it better, But there's a whole bunch of other assets that Niti Aayog has identified many years ago, infrastructure assets, where the upstream work is done by the government. These are operational assets. They generate revenue. And so the government can easily say, this is not our business to hold anymore. and some other pension fund can hold it. So a systematic plan, not just for revenue extraction, to sell assets and disinvest at a proper pace over the next 3-4 years, that has two benefits. One is it gives you the resources to consolidate, but it allows you, because these are asset sales, and in many countries get counted below the line, but in our case we count them above the line, you can use that to reduce the deficit without it being contractionary. So we've spent so much time saying, how does the budget impart a stimulus? And we've been saying, well, there's no stimulus here because deficit have to go from 4.9 to 4.5. But one way to bring the deficit down without imparting this contractionary impulse is to do so by asset monetization. And that's why I think that needs to be an important part of the toolkit in the coming years.
Okay. No, you're putting it very passionately, but I'm really cut up with the government that at a time when so many private equity and private entrepreneurs have cashed in on the market in the last 2 years, the government has not done that. That would be a sore point. But time permitting, we'll come back to that. Neelkanth, let us look at the other thrust, the intangible thrust that the government can give. We were told in the last budget that an economic policy framework will be placed before the people in the new budget. What kind of a thrust can they give? Can there be a fresh announcement on employment? Or do you think it should be an announcement on PLI, break into the global supply chain, something that spurs the animal spirits?
See, the PLI schemes by themselves are actually very small. So as we've discussed often on your shows, the total spend is like 2.2 lakh crores, even after some increase, 2.4 lakh crores spent over 8-10 years. I mean, it's not even 0.1% of GDP in any year. Even the semiconductor subsidy scheme, which is not a PLI, but it's a 50% capex scheme, at that point, $10 billion was 76,000 crores. Most of it is exhausted. So it is reasonable to expect that there could be a second semiconductor policy, subsidy that could come in, because there are still more plants that need to come into India. I think we spent the first batch very well. I think more needs to be done. There has been enough newspaper coverage on, say, electronic components PLI, and that could be launched as well. So there could be some sector-specific interventions, but the problem that we are trying to solve is something which is at a macro level. So will it by this itself trigger, say, 0.5% of GDP worth of investment? I think it is unlikely to. So therefore, what is required is some of what Sajjid was suggesting, that we lay down a path as to how do we manage it better. See, for example, no one in the line ministries is sitting there waiting for the right opportunity to divest an asset. Yeah. So if there is an insurance company and its stock price has gone up a lot, oh, this is a good time to say, shave 10% off our holding. No one is doing that. And therefore, consolidating government holdings into one fund, which is then managed by specialists, is a very important reform that should be contemplated. And see, remember that there is an 8-9 month window till the next state elections, which allows some leeway for some of these decisions to be taken. So if there is something which dramatically changes the ease of doing business, something that creates this optimism around government stepping away from these sectors over, say, even the 3 years. If nothing happens this year, that's fine. So long as there is a visible path, I think that will create the animal spirits, which can be a meaningful stimulus to the economy.
Okay, something like a sovereign wealth fund of a different kind, which can divest very quickly. I take your point. Several times when we have spoken to Tuhin Kantapande or whoever is in charge of divestment, there's a litany of things that they have to do. First, like for instance, LIC, converting it from a corporation to a company, or for that matter in Concor, so many land titles, so many things are not clear. So, it's about time that's moved on. So, a similar question to you, Samiran. Can there be something dramatic that can be done in terms of, they also promised that they will look up the import-export tariffs, especially import tariffs to remove inverted duty structure. That coupled with a PLI, and at a time when hopefully the anti-China wave from Trump will open up some space for us, can all this be packaged into a big export thrust? I mean, I'm not putting words in your mind or in your mouth, but can something be done on the export front?
So for me, the critical piece will be this economic policy framework. It can potentially have many cues for the market, which will run for a while. And within the economic policy framework, if I recollect correctly, in the budget speech of Finance Minister in July, it was clearly mentioned that there will be focus on structural reforms. And that's where, if you connect it with this whole China plus one story, yes, I understand that correcting these inverted duty structures is one component of that. But what we continuously hear is some kind of, in the want of a better word, ease of doing business issues. And there, these land, labor, these kind of things, if we get a roadmap out of this economic policy framework on how the government is thinking about them, then it could potentially make more MNCs think of India as that diversification destination. And to my mind, that will be a better kicker for the development of manufacturing here. I do get the point that Neelkanth was also mentioning, that our total industrial subsidies, if I may use the word, is so little compared to what rest of the world is doing, that there is scope for that. But the only thing is that that will be on budget. So on budget, that means there will be the fiscal impact of that either this year or next year or next year. Whereas if you focus more on the ease of doing business, on reforms, it's actually fiscally zero cost.
Yes.
So that way, it could have a big
No,
kicker.
please add to that, because that's what Vivek Ramaswamy and Elon Musk are telling us, that, we'll be able to make life easier.
We've been painting the global environment as being so hostile in the near term. But there's a huge opportunity in this for us. Because once perceptions get embedded that the US and China are going to be at war with each other on a trade front forever, guess what? You're going to get more diversification from multinational companies. Say, you know what, we really have to find places outside of China. There are few countries of India's size and scale that can absorb that, A. And Chinese FDI will be looking for other homes in Asia. So this is actually a unique opportunity for India because, A, you've got these initiatives, and B, this is the first full budget of the third term. And so there's a lot of political capital this time. So I think both these things have come together. The July budget had many interesting starting points there. It did speak about how we want to boost exports in the economic policy framework. And alongside that said, we will review basic customs duties, number one. It did talk about structural reform. It did speak about labor-intensive growth. We forgot that the thrust of July's budget was more employment. How do we make growth more labor-intensive and less capital-intensive? So there are many really important, intriguing starting points here. I think this budget has to begin to take some of those initiatives. How do we get into global supply chains? How do we rationalize import duties? How do we get more China plus one? How do we start and process a roadmap to work with the states on reforms? How do we make growth more labor intensive? What's the early scorecard on the July initiatives? How can we build on those? There's a lot of stuff here that we should focus on outside the budget math.
Okay, so you would agree that probably the economic policy framework could concentrate on releasing that space, global space. But we didn't ask you the most important question that the market is waiting for. Will we get lower taxes, income tax? After all, income taxpayers have made the government rich. I told you that personal income tax grew by 23.6%, where the government expected only 13.6%. So, is there a chance?
We did the fiscal math, right? So, in that, there is, I said 80,000 to 1 lakh crores of space, whether you spend it on capex or you spend it on tax cuts. I think it is, the multiplier is much better if you spend it on capex. And so, see, whatever estimates we take, next year's GDP is going to be, give or take, 360 trillion rupees.
356 if you do the math. Anyway.
Okay, around 356. If you spend another 50,000 crores on a tax cut, it's a rounding error. So when we think about supporting GDP growth or boosting GDP growth by another percent and a half, which is what we should aspire for, these tweaks of 5, 10, 15 basis points are not going to move the needle. So I think
this is also about helping individuals, Neelkanth, right? I mean, the 50,000 crores.
Why are you pointing only to me?
The tax cuts, essentially what I was referring to. Not just, there's boosting GDP, which is the bigger sort of overarching aim, but also relief to taxpayers. I mean, there is also that element.
But then, the bottom, I think we should be hard-nosed about this. If you're spending resources, where do you get most bang for your buck? I would argue expenditure multipliers are bigger than tax multipliers, so more on capex. If you are going to help individuals, you want to aim at the bottom of the pyramid because that's where the multiplier effect of every 100 rupees you give is higher, right? So I think you need to be clear about where you will get more bang for your buck.
And generally, I would say that on tax rates, there's also, and I'm assuming this question would come next, is what happens to capital gains taxes? I mean, we'll see another division. So, see, one of the biggest criticisms of India when you compare it to, say, Vietnam, is that our tax rates are too volatile. So we just streamlined the taxes in July. Why do you want to revise them again in February?
They're not volatile, they're directional.
No, I mean, they keep changing, has been the problem. So once you've changed them, then you let them be. Let the businesses, let the economy settle down around those tax rates. Even when you are, so see, there can be tweaks. Maybe the thresholds for certain slabs can be revised. Maybe some slabs are too narrow. They can be widened. So some tweaks can happen. But that will, at margin, release 25,000-30,000 crores. And I don't think at a macro level, that's really going to have an impact.
Okay, just last word, one sentence from each of you on what should the stock markets be prepared for. Anything, okay, Samiran, you say that first. Anything that, lower taxes is which would, especially capital gains, would excite the market, but anything that they should watch out for, positive or negative?
I will give an economist answer that I will look for the economic policy framework document with the most intent.
Okay, anything?
I think you should plan the budget by taking into account the economy over the next 5 years, not the stock market on the budget day.
Okay, Neelkanth?
Yeah, I would have a very similar.
By the way, the budget is on a Saturday. So
I think the markets
will trade on that.
Markets are open. So, I mean.
Okay, we lose the Republic Day holiday and we work on the following Saturday. So we deserve a compensation. Neelkanth, Samiran and Sajjid, thank you very much for kicking off the budget town hall with such elan. The important takeaways, one, that the budget should stick to its fiscal conservatism and keep to the 4.5% fiscal deficit. That's one common takeaway from all of them. A second takeaway is that don't expect too much by way of stimulus monetarily. Even if it is, it should not be lower taxes. That's the second wet blanket that we got from our guests. It should not be lower taxes because expenditure has a higher impact, multiplier impact on the economy than lower taxes. And third, and the most important takeaway that they tell us is that you can have an intangible thrust in the economic policy framework, saying that you make India, a kind of policy ready, capable of grabbing the chances that may come when industry wants to flee China, especially if there are very severe tariffs from President Trump. So perhaps something big can come for exporters and for domestic industry from the budget. That's what we're waiting for. Thank you very much once again.
Thank you.